Welcome back to How to Invest in Commercial Real Estate. We have a super exciting episode, and we've been gone for a few weeks, right? So Brian was busy vacationing. Joel, you were in Japan, right?
Just checking it out.
Brian was just skiing. How boring!
For 2 weeks.
Yeah, nothing like Japan.
And
But anyway,
and you went to Branson.
small road trip. Yeah, it gradually declines as we keep talking. But anyway, since we missed a few weeks in the podcast here, a lot's changed kind of in the financial outlook of the world. A lot's happening right now of the past few weeks. Everyone's heard about some of these bank closures happening stateside. We've got Silicon Valley Bank that went under. And the Fed met again yesterday, and we're talking about another quarter point on the interest rate. And on top of that, we have, the administration talking about how much of SVB is going to be forgiven and everything like that. So it's kind of an interesting time where a lot of people, I'm getting hit on all ends. It seems like, what are you doing with your cash? Oh, the world's ending. Banks are going under. And kind of everywhere in between. And,
Yeah, I don't think the world's ending. I don't actually think that many more banks are going to fail. But Fed funds rate is up, and prime now is 8%, which is a pretty big deal from where we were just a year ago. I think we're up almost 2 points in just the last year.
Yeah, that sounds right.
And so it's making borrowing a little bit tougher. But the good news is, for some assets, the 10-year Treasury is remaining relatively low. And so the 10 years about 3.5 right now. And, you can still get deals done at 2.25 over the 10-year. So that puts you at 5.75 versus 8% on prime rate. So we don't have to get too much into that. Why don't you introduce our guest for today?
Absolutely. So we have Sujay here with Bloom Ventures, and we thought this would be an amazing guest because, like Brian mentioned right before we got on, this is our 99th episode. Yeah, we've been talking about commercial real estate for years now on the podcast, and we've never had somebody who owns hotels, who specializes in hotels, who I hear manages their own hotels, which is kind of even more difficult to do if you know anything about hotels. So anyway, I'll introduce our guest, Sujay, here. Tell us about yourself. Tell us about Bloom and hotels.
Absolutely. Thank you so much for having me here. It's a pleasure, and let's do it. I'm excited to debunk the idea of owning a hotel, right? So again, like mentioned, my name is Sujay. I'm from Columbus, Ohio. I'm a Buckeye at heart. And Bloom Ventures, it's our real estate firm. We own quite a few hotels. So, we franchise the hotels with Hilton, Marriott, Hyatt, all these large brands that many of you guys have heard about or, driven past on the highway, on the road, when you go to visit cities and probably stayed at, to be honest, right? We don't like Airbnbs. So we own those real estate assets, and then we franchise with the hotels, and we give a royalty payment to those franchises. And so, my name is Sujay. We manage those hotels. We run the hotels. And it's one of the best asset classes in real estate that many people don't know about. And it's so awesome what you guys are doing and really getting that information out there. So
let me, that brings me to my first question, because I think, like you mentioned before the podcast, so many people driving by, they think, oh, Marriott owns that, Hyatt owns that. And they never thought, hey, that's a piece of real estate that I could own and I could be getting the cash flow off of that. And so you're here to kind of, debunk that myth that the average person can be a hotel owner with some really quality brands in their portfolio.
Absolutely. And it's crazy because the same place where people are finding multifamily assets for sale or other businesses for sale have these hotels listed. It's just, we don't filter it that way, and we don't look for it, and we don't have that perspective in our mind that, hey, I can own this asset class, right? So, CBRE, LoopNet, Marcus Millichap, all these places
10X.
Have these hotels. 10X, absolutely. And you guys alluded to kind of the bank crisis happening right now, and it's going to create a lot of opportunities for people to buy at a very, very good price coming in here soon. So.
Well, sorry to interrupt here, but I'm going to ask a couple of questions because I know people will have, these questions. Is compare the hospitality industry, which is how you need to search if you're on some of these LoopNet platforms. You're looking for hospitality. That's going to include hotels. But what are the cap rates you can buy these at? What are the typical cash on cash returns you're trying to hit? And then what does the debt picture look like? What's the leverage on these compared to a retail strip center or a multifamily deal?
Yeah, that's a good question.
Perfect. So 3 questions is what I heard. So we'll start with the first one. So the first one was, kind of what kind of cap rates are we looking for? So when you look at multifamily, I guess, a couple years ago, 2021, cap rates were really at around 3.5, 3.75, depending on class A, class B, class C, right? Moving into this year, I feel like cap rates have really gotten up to the 4.5 range. When looking at the hotel industry, it's a little bit different. So we don't really have, there's class A, class B, class C assets, but those are really quantified by, one, the age of the property, 2, the flag that they're associated with, right? Mm-hmm. So when you think of what's the best hotel, what's the Louis Vuitton of hotels, right? You would think Hilton, Marriott, probably the 2 big giants at the top. You have Hyatt as well that have some pretty nice properties, and then IHG. So, when you have those assets, those are kind of at the top of the tier, where, most of the times those are class A, and those are going to trade for a little bit lower cap rate than you would if you had a choice asset. So Comfort Suites, Best Western, some of those. And then you have your economy brands that are kind of a little bit more at the bottom, what you would refer to as a motel, exterior corridor, maybe right off the highway or in a smaller rural area. Again, those are going to have the best cap rates. And, a lot of times those are the cash flowing assets. So maybe not the prettiest, but definitely where the dough is, right? So, but yes, going back to the cap rate, it could be anywhere from 8 to about 12% cap rate. And, again, depends, is it a distressed asset? Is there opportunity to bring value through renovation or, what we call it a PIP, a property improvement plan. And so a lot of those factors really come into play here when thinking about cap rate. So the second question was cash on cash return, right? So cash on cash return, something that we look for as an investment firm, and it's kind of our strategies, right? So there's no right or wrong, but our strategy is to get a portfolio deal, a deal that we can keep inside of our portfolio for 15, 20 years if we have to. We don't want to be limited to, hey, the circumstances is changing, now we have to pivot. Real estate is very similar to the stock market in a sense where, if you hold on to the asset or you hold on to that stock for an extended period of time, you're not going to lose your money. Now, if you have, if you over leverage, if you're on margin, if you're doing options, now all of a sudden you're bound by the circumstance or the time or what the situation is. And so, we look for about 10 to 12% cash on cash return at least. And that could factor in, new management changes, increasing the efficiency for the bottom line and doing that. So cash on cash return, about 10 to 12%, plus then you're building equity because you're holding on to this asset for 15, 20 years. You're paying down the principal payment. And which kind of segues into your third question, which is, what does the debt look like? So typically, 2018, 2019, we were finding deals for almost 20% down, 25% down, 80%, 75%, bank leveraged. But now we're seeing a little bit more resistance on that 25% down payment. And it's kind of almost sneaking a little bit more into that 30%, especially if you're going non-recourse or, institutional lending. You're looking more at about 30, 35% even. So
that makes sense. I mean, COVID was a huge shock to the hospitality system. So I can see lenders being a little bit more conservative coming out of that type of a period.
Yeah, I'd love to maybe talk about your portfolio through COVID. I mean, it sounds like you guys own a decent amount of hotels, and I would think that's the scariest thing in the world, right? Because people love to give us crap about retail. Oh, Amazon's gonna end the world. COVID messed your life up, bro. You ain't got no money. So like, nobody traveled during COVID. Obviously, hospitality went down, but give us the practical sense of what you guys experienced.
Right. So Rudy Gobert has that press conference, touches the microphone. NBA shuts down, the rest of the world shuts down, right? Like that's kind of how it happened going back a couple of years. And I remember that week, we were building a hotel and we were about 90% complete. We were getting ready to open. End of April of 2020 was our opening date. And, the city went on lockdown and city officials weren't working. So people who were coming to inspect the property, they stopped working, and it was chaos, right? So they're not working. People aren't coming to visit our properties. It's just essential workers, traveling nurses. We started getting calls from the city asking if we want to turn our hotels into hospitals or shelters for homeless people.
Wow.
Yeah. And so at that time, as a business owner, and we're always pivoting, we're always thinking on our feet, right? So we had to make a decision that, hey, do we want to turn our asset into a homeless shelter, or, a shelter for the underserved, and possibly run down our real estate and still be able to make some money in this time? Or should we just hang on, sit tight, and kind of weather the storm? And we actually decided not to take any of those opportunities, which in hindsight, I'm glad we did that, because a lot of assets now are shut down because those properties were just run down so much in the last couple of years, and now they can't rent it to regular leisure customers. So it was a really tough time, and like you said, we were freaking out. I mean, to say the least.
Everybody was, I'm sure.
We were struggling. And to be honest, you guys can make fun of me a little bit, but I just got a hair transplant about 3-4 months ago. That's why I'm always in this hat, right? I just got a hair transplant because I lost all my hair in 2020. No joke, right? So, but we bounced back really well.
That's great.
By the end of 2020, we were able to, occupancy was high, with inflation. The great part about hotels is we're adjusting our rates every single day, right? So when rates started going up, we don't have leases that are locked in for 1 year, 18 months, 16 months, those kinds of leases that lock us in. We're able to adjust every single day. Where that hurt us in the beginning of 2020, where we, people were just able to walk away or negotiate really low rates. Typically we're charging $90 a room and we're taking people in for $55, right, during that time. But now at the end of the year, when people were kind of cooped up, sick of cooking and sick of staying in their house, and a lot of people were just driving wherever they could, they were staying at hotels in between cities when they're traveling. And we were really able to take advantage of that. We weren't serving breakfast, which is a huge cost. So that added to the bottom line. Even if our revenue was down, we were able to make money because, that $4 or $5 a room that we budget for breakfast was coming straight down to the bottom line. Housekeeping or cleaning costs had gone down. So
yeah, you weren't cleaning the rooms. I used to get the notices that, hey, we're not coming in your room. And so, yeah, the labor costs had to go to almost zero for you guys.
It was good. It was a blessing in a way, and it was a safety thing too, right? We didn't want one person on our payroll gets sick and it just spreads to everybody, and we had to deal with that stuff too. But we ended up bouncing back pretty well in 2020. 2021 was an astronomical year. I mean, it was great. At least most of the hotels in our portfolio, we were able to beat 2019 numbers as far as a profit standpoint. Business travel hadn't come back as much, but leisure travel was just astronomical.
People were flush with cash because of like $7 trillion of stimulus being flooded into the market.
Quantitative easing, guys.
Yeah, whatever we want to call it. Yeah. But I'm sure it helped because everybody had all the cash and they wanted to spend it.
Now nobody's got cash and we're doing some quantitative tightening. That's all it is. That's all it is. It's just some tightening.
Tax season comes and they get the refunds. All of a sudden our hotels are filled. I mean, it happens, and it's a trend that you get to see so much in the hospitality industry.
Sujay, I think you need to help us buy a hotel.
I definitely think we want to buy hotels with you. Because like I said, I've literally spent years like looking and making some offers, and then COVID hit and I was like, okay, I don't know anything about this. But no, that'll be super fun. So let me ask you this, because sometimes cap rates at one measure, the debt we can get on it's another, but there's also metrics like price per foot. And I think in hospitality, it may be price per key or price per door. So do you kind of factor in those metrics to buy on an overall value basis sometimes?
You sound like a real hotel guy now. Price per key.
Trying.
Right. So when we're underwriting, we look at a lot of different things. So one of the things that we do look at is replacement cost, right? So and we call it per key. I know in multifamily they call it per door, but in the hospitality industry we say per key. because we have those, we have those keys that get us in and out of the doors, right? So typically, and it depends with the brand. So typically when we look at an asset, we look at the age of the asset. So if it's within 6-7 years, it hasn't even gone through its first renovation yet, I consider that as fairly new. And so when I'm looking at a 6-7 year old asset, I'm looking at what is my replacement cost, right? So typically for Home 2 Suites, which is Hilton's new extended stay, crushes it. I mean, that asset is, I mean, that flag is so profitable because of the, extended stay portion that it has and the way that it's able to command rates. It's so profitable. And I mean, we're building one right now, and I would love any opportunity to pick up a Home 2 Suites as I could. So, but those are a little bit higher on the construction cost. So, those are about $130,000 to $150,000 a key, depending on location, land value, those sort of things. And so when we're looking at an asset that's 5 to 7 years old, we really compare it to, hey, if I were to build a new one tomorrow in the same market, how much is it going to cost me versus how much of a discount am I getting for this 5-7 year old asset? The other thing that we have to consider is, for me to build, it will take a minimum of 18 months, probably closer to 24 months, from beginning to the end. And that's 2 years of not having cash flow, not having revenue. So when you're going in and you're buying an asset, I mean, that's something else that we look at, and we're looking at those 2 years safe. So that impacts your IRR significantly, right? So that 2 years of no return. So, I mean, to answer your question, we're always looking at replacement costs and how much it costs per key. Typically, in this environment, it's going to cost between $110,000 to $150,000 a key to build that hotel. And obviously the number of doors that you have and all those things are taken into consideration, plus the flag. Is it a Marriott? Is it extended stay? Is it limited service? So
very interesting.
Yeah, at the end of the day, it's very similar, right, to multifamily or to retail. We look at those things when we talk about buying existing properties or development. So at the end of the day, it's similar.
I mean, if you can get 10 to 12% cash on cash, that sounds familiar. And
Yeah,
if you can get me a 20% IRR, and if you can get me an asset I can hold for 15 years without having to go and work and try to buy more and deal with the disposition and acquisition, I mean, why aren't we buying more hotels? Is the question I'm asking myself when I'm listening.
It's the same point we've told people on this podcast from the beginning. You're just one piece of knowledge away. You're one person away. You're one piece of experience away from getting comfortable enough to put your money down and buy it. Yeah, right. And it's just like self-storage or any other asset class that we haven't really done a lot with. It's just you just have to have somebody that knows or can make you feel like, hey, this is going to be okay. Yeah. When the occupancy drops, here's how we're going to deal with that. And so once you can get comfortable, that'll give you the confidence to move forward. I would ask one other question. I know we're kind of getting long on time, so we'll wrap it up after this. But I do think on hotels there would be some additional consideration with how many doors there are in a given radius or a given market. Because there's only going to be so much that you're going to be able to withstand in a given area of the town. I think maybe I didn't say that right, but
yeah. So it's supply and demand, right? When you look at a market, you want to make sure that if you're entering that market, what is the trend? So two things here. One, when you're looking at an asset that's already existing, so a hotel that's been around for 10 years, 15 years, the great part about going into a deal like that is you have historicals. Right? You can pull the last 5 years P&Ls. You can look at the trends. You can see, okay, it did $2 million in business last year. It did $3 million in business last year. Chances are that that's not going to just disappear overnight, right? So you can look at the last 3 years. You can see, is it trending up? Is it staying flat and consistent? Is it going down? The other thing you want to do, which I'm sure everyone does, no matter what asset class they're looking at, is new supply coming into the area, right? So you can go to the city, you can see have any permits been pulled. We can call the franchises, we can see is there any new flags coming into the market, and that's really it, right? If there's history of demand in that specific market, if there's businesses there, there's maybe an attraction for leisure travel. I mean, chances are it's not going to just disappear overnight. With ADRs and inflation, and we say ADR, average daily rate, with rates going up, even though our occupancy may increase 5%, if we're able to keep our rate up, revenue is actually growing year over year, even though occupancy may be down from last year. And so that's one thing for when you're buying an existing property. When you're building a new property, which is, I love building new properties, right? And, it's something you can hold on for 15, 20 years. You talk about generational wealth. It's something that will stay in your portfolio if you manage it right for a long period of time. But when you're building a new hotel, let's say you're going on a trip, there's a brand new Hampton Inn and there's a 15 or 20-year-old Fairfield Inn. One's a Hilton, one's a Marriott. Which one are you staying at?
The new one.
Same price. The new one, right? Yeah. So the beauty of building a new property is you just have to steal business, right? Even if you take 15% from 10 different hotels, you're over 100% in demand, right? Yeah. So that's the beautiful thing about having the newest on the block or the best property on the block. So
maybe we don't want to buy, well, we may want to buy hotels, but also we want to build them. I may have a site for you that you can compete on, actually.
What site?
Well, with our Bixby development, the east part of the city's development, we're looking at a potential hotel. It's right across from a brand new mixed-use multifamily, Class A multifamily retail deal. So, and it's right across from City Hall in Bixby, Oklahoma, which is small town, but they don't have any hotels. So,
I feel like now, me and Brian need to be looking at that deal with Sujay over here.
Yeah.
The hotel pad. This sounds like a win-win-win-win.
Hey, we'll go ahead and wrap it because we're almost a half an hour. This has been so informative for me. First of all, congrats on your success. And thank you for sharing some of your insights and information and what you've been successful doing with us and our listeners. We really appreciate it.
Yeah. Do you have a plug? Do you have a website that our listeners can go to?
Yeah. Follow me on Instagram. SUJMEHTA, Sujay Mehta. My website is bloom.ventures, but Instagram's fun. So follow me on Instagram.
Awesome.
Yeah. All right.
Well, man, we will definitely be in touch with you. We'd love to help fund one of your deals. Thank you again for coming on.
Absolutely. It's been a pleasure. Let's connect.
All right, guys.
Good. Sounds good.
Thanks.